Okay. Wait 1 second. Let me turn this thing on. Okay. I guess whenever you're ready.
Hello, we are Pinnacle Cycles, and I am Kevin Korea, the president, and then we have Naima, VP of Marketing and Business Analytics, and we have Julie, VP of Human Resources and Sales Management, and we have Catherine, VP of Accounting and Finance, and Giselle, VP of Manufacturing. So for the executive summary, our summary is to build fast, reliable, and value-driven bikes that deliver both performance and adventure. Our segment focus was the speed and mountain bikes, and eventually also recreational. So this was our booming start. What we did in the first year and a half, and how we performed in the market and financially. As you can see, we started off pretty much selling double more than everybody, pretty much everybody combined. So and then eventually our competition started catching up to us, and we started decreasing. As you can see, share of units sold and also the market share. Same thing. We started off super good, and then as competition eventually caught up to us. But we were consistently profitable. You know, Q1, our startup costs obviously were low. Uh, 2, 3, we had strong sales profits, and then 4 for some reinvestments. It took a dip. 5 we recovered, and then 6 was our biggest one, over 1 million. Also, cash is king. So we've had a positive cash flow the whole time, as you can see by the chart. It's been steadily increasing, and we have zero debt. But overall, the wealth, we made the most money for our shareholders, as you can see in the chart. We beat all of our competition in that part, and also the overall our CBS, what I like to our report card basically. Overall, we outperformed everybody, as you could see, big time. And what we plan to do next, our dip was because we didn't invest in some research and development later on, which we will if we would kept going for Q7 and on. And this was our award that was given to us by the marketplace simulation, the first place, Pinnacle Cycles.
So, as for our overall corporate strategy, we decided to focus on value-driven markets, and this was by offering the affordable and reliable bikes that we sell. We have been investing in quality as well as environmental efficiency and responsibility. And with this, that we can now grow long-term in the manufacturing department and also compete strongly with performance and customer satisfaction. We are also able to meet about 90% of our corporate strategy. As for our financial business plan, we overall found growth, profit, and long-term success. This was by our finance operations conservatively by avoiding debt and keeping liquidity. And we were also able to grow our market presence by increasing our sales and market share. We also improved profit while maintaining strong cash flow. And we also invested in R&D and production in order to support innovation and future growth. Lastly, we built shareholder value through long-term growth, even if our profits were initially delayed. So now we have our financial actions that we took versus our original business plan. Originally, our goal was to avoid debt and maintain liquidity. This we were able to partially complete. While we did remain debt-free, in Q4, we had to rely on equity and also certificate withdrawals in Q6. As for our grow market presence and increasing sales goal, this we were able to 100% complete due to our aggressive marketing, product expansion, and entry into new segments. Then as for improving profits and cash flow, this was partial as well. We did have positive net income and operating cash flow in Q5. However, in Q4 and 6, we did have a negative net income and operating cash flow. This was due to heavy R&D, production, and marketing that we were putting our money towards. Then as for investing in R&D and production, this we were able to 100% complete. We did this by having high capacity and R&D investments that took place every single quarter. Lastly, we were able to build shareholder value somewhat. We did have equity, which increased in common stock on Q4. However, we did see a negative in returned earnings and an EPS drop in Q6. As for our departures versus business plan, like I had initially said, that we did avoid debt and wanted to maintain liquidity in our company. We saw that cash reserves were below our plan, and we had to rely on the $2.4 million in equity in Q4. And we also had to do some certificate withdrawals in Q6 to maintain our liquidity, which was $450,000. As for how we justify this is that we just needed funds essentially to cover our negative operating cash flow, and we did not want to go into debt due to this. As for our improvement of profit and cash flow, we did see a negative net income in our operating cash flow in Q4 and Q6. Our justification for this was that we had some short-term losses that happened from our heavy use of R&D and production and marketing costs. However, this was due to the fact that we needed to support our overall long-term growth. Lastly, building shareholder value was very important in our plan. We did see an EPS decline as well as negative returned earnings in Q6. However, equity issuance diluted also in Q4 in terms of ownership, and our justification for this was that we needed to sacrifice short-term shareholder value in order to have financial expansion and a secure future market in terms of our leadership. So some significant financial events that took place in Pinnacle Cycles. As for this, we had some equity financing in Q4, which was the only quarter that we needed to have this happen. We were able to raise $2.4 million in order to fund operations, but this did dilute our shareholders in the end, which was not good. Heavy R&D production, for that, we did see some high investment on our end. However, this resulted in short-term losses, but a long-term growth potential. We had marketing and sales expansion through our aggressive campaign style. This led to increased revenue for us as well as a higher expense in Q4 and 5. As for our operating losses, which were seen in Q4 and Q6, this in the end reduced our retained earnings and EPS. Lastly, we did have some 3-month certificate withdrawals in Q6 in order to stay afloat. This was $450,000 withdrawn that I'd mentioned earlier, and this was to maintain liquidity without debt in our company. As for our financial goals versus how we performed in terms of KPI, as said before, we did avoid debt and maintain liquidity, even though our cash fell in Q6. Then we had an issue with our market presence and sales. We expanded marketing and products, but the demand was still uneven in the end. Then, in terms of our goal of improving profit and cash flow, we had a partial response as well. In quarter 5, as you can see in the diagram, we were extremely profitable, but in quarter 4 and quarter 6, we had to go negative, unfortunately, and this was due to the heavy R&D, production, and marketing that we had to pay for. Then our goal in investing in R&D and production, we were able to 100% achieve this in every single quarter. Then lastly, our building of our shareholder value, this was also partial because our equity did increase in quarter 4, however, in the end dropped in quarter 6.
Okay, so I'm going to be presenting on our manufacturing portion of our simulation. So on the left, we have our business plan goals for manufacturing, and we have as well the how we performed on each goal. So to start off, we wanted to continue to expand our fixed capacity in these last 3 quarters. So in quarter 4, we were able to achieve that by increasing our fixed capacity to 48 units a day. And then in quarter 5, again, increasing it to 64 units a day, which exceeded the minimum requirement of 54 units a day at 71% productivity. And then in quarter 6, we were able to not only achieve but exceed our goal by expanding our fixed capacity substantially to ensure we had enough coverage to meet the demand. We also want to continue to optimize our operating levels, and this was partially achieved in quarter 4. While we did raise our operating capacity to 44 units a day, we did have a little bit of a lag behind the demand. And then in quarter 5, we were able to achieve this by pushing the operating capacity to 62 units a day to cover the forecasted demand. And then in quarter 6, we're also able to push our operating capacity to a near fixed maximum, which was 86 units a day versus the fixed capacity of 88 units a day. And we continue to maintain our productivity for the next 3 quarters. We were able to keep our productivity at 71% for quarter 4, though we did use a little bit of overtime that hindered it a bit. In quarter 5, we were able to raise our productivity from 71% to 75%, and it helped offset a little bit of those labor cost increases. And then for quarter 6, we were able to strongly achieve this goal by improving our productivity again to 77%, despite the pressure from our mass expansion. And then these next 3 quarters, we also really wanted to limit the use of our overtime. So in quarter 4, we ended up limiting our overtime use to only 1 hour a day to close the demand gap. And then while in quarter 2, we did keep our overtime only to 1 hour, we did have to rely on it versus in quarter 4. So we did have to use that overtime in quarter 5. So therefore, in quarter 6, we did have to increase our overtime just a little bit because it was needed due to the market conditions. And for controlling our costs throughout these quarters, we did achieve this in quarter 4 by having minimal increases in overhead and avoiding excessive overtime, which would have inflated our unit costs. And then in quarter 5, overhead was reduced, and we only used a moderate amount of overtime that was accepted, and the overall cost of management remained pretty strong for that quarter. And then lastly, in quarter 6, we were able to reduce both the direct labor and overhead costs per unit. So we were able to achieve that in those quarters. Next slide, please. And so now for quarter 4, this was our performance. Some actions that we took for quarter 4 that align with our business plan is we did increase our fixed capacity to 48 units a day, and our operating capacity adjusted to 44 units a day. our productivity did stay at 71%, and we did limit our overtime again to 1 hour. And our new direct labor cost was at $52, while our overhead unit was at $21. And some departures versus business plans for this quarter was that our effective operating capacity of 2,031 units was below the projected demand of 2,370 units. And for justification for this is while the shortfall was minor and deliberately managed with controlled overtime, we did want to keep the overtime low in general just to avoid overinvesting in overtime too early. And while our productivity did fall slightly below 72% with it was still stable at 71%, and we just wanted to this quarter prioritize towards our capacity expansion versus workforce improvements. Next slide, thank you. For quarter 5, some actions we took for this quarter is we increased our fixed capacity again to 64 units a day. We also increased again our operating capacity to 62 units a day. So we wanted to make sure that we kept it close to the maximum fixed capacity utilization. We kept overtime at 1 hour, which did slightly dip into our productivity just a little bit. Our direct labor costs did go up to $54, while our overhead and unit costs did go down to $17. And then for this quarter, for our departures versus business plan, we did have to rely on overtime this quarter, but it was necessary to bridge the gap between the demand and the effective operating capacity. But some significant events that we had for quarter 5 is that our projected demand increased to 2,925 units, which required larger fixed capacity and more aggressive operating adjustments. And our worker productivity did increase from 71% to 75% without having to have a cost increase. And then our direct labor cost again rose from $52 to $54, while our overhead declined significantly from $21 to $17. Lastly, in quarter 6, we did a big significant jump in our fixed capacity to align with the surge in demand. So we increased our fixed capacity to 88 units a day. And our operating capacity, we try to get as close as we can as the maximum. So we did 86 units. And for productivity, we were able to bring our productivity back up a lot to 77%. And our new direct labor costs did fall slightly a little bit to $53, but our overhead unit and unit costs did continue to drop further to $14 from $17. And for this section for departures versus business plan, while we did want to control the use of heavy overtime, we did have to increase just a little bit this quarter to meet the extreme demand. And since we had used it last quarter, decided to up that a little bit for this quarter. And then some significant events is we did have a huge demand surge in this quarter. So our projected demand had nearly tripled since quarter 4, from 2,370 units all the way to 7,280 units. And we did have a big improvement on our workforce productivity, which rose again to 77%.
This is the marketing business plan goals. In quarter 4, I invested in super traction mountain tires, very fast racing tires, and carbon fiber aerodynamic handlebars. The recreation bikes had lower prices according to customer needs. Mountain and speed bikes are priced around competitor prices. In quarter 5, I was deciding to invest in enriched carbon fiber material, performance bike, computer, carbon fiber riser, handlebars, and full suspension. I didn't invest in these features because of the high cost. Instead, I decided to invest in wet and dry carbon ceramic disc brakes, bright, colorful frame, high intensity LED light up kits, and extra smooth derailleur because the costs were lower, and I was able to incorporate these features to each brand segment. I did decrease prices because some of the ratings were below 100. In quarter 6, I was going to to new previous brands such as R30, R40, and S40. I ended up keeping the brands because of the high profits. I was deciding to design one new brand segment, and then I decided to design two new brands segments, two new brands for each segment to increase sales and brand ratings. I decreased some of my prices to have a lower or match competitor prices. And the next slide is marketing goals versus performance. One of the goals are to expand market share. I didn't achieve this. The market share decreased every quarter. The second goal is to increase brand ratings. In quarter four, all brand segments were in first place. In quarter five, I was able to increase my mountain bike rating and speed bike ratings. In quarter six, I was able to have higher ratings for recreation and speed bikes. The third goal is to improve price ratings. In quarters five and six, I achieved this, and the price ratings were 100 for all three segments. The fourth goal is to improve ads. I was able to improve ad ratings for speed, mountain, and recreation ads in quarter six. The next slide is marketing performance. In quarter four, the market share decreased by 1% from quarter three. R40 was the highest rated brand for the recreation segment. M40 had the highest rated score for the mountain segment. S40 had the highest rated brand for the speed segment. Paid SEM results showed Pinnacle Cycles had the most impressions for each segment. In quarter five, R40 was still the highest rated brand. M50 was in second place for the mountain segment with a rating of 70. S50 came in second place for the speed segment, and market share decreased by 13% from quarter four. It also had the most impressions for speed and the recreation segment. In quarter six, market share decreased by 6% from quarter five. R60 and R65 got a brand rating of 88 and are in second and third place. M60 and 65 came in ninth and 10th place. The rating for S60 is 88, which came in third place, and S65 with a rating of 85, which came in fourth place, and it also had the most impressions for each segment.
Alrighty, so for our sales performance business goals from quarters 4 through 6, our goals were to grow sales revenue past $5 million, to maintain strong gross margins, meaning 60% or above, increase market reach via global expansion, improve sales productivity, and build reputation and demand. Next slide. In quarters four, sorry. In quarters 4 through 6, our sales team hit a major milestone, over 5.5 million in sales revenue by quarter six. Even though our sales force was smaller than other companies, we focused on efficiency. So we averaged about 242 units sold per salesperson. That lean approach helped us keep payroll costs down while still delivering strong results. We also maintained a healthy gross margin of over 61%, which shows that our pricing strategy and cost control were effective. We expanded our presence across New York, Amsterdam, Rio, and finally Bangalore, which gave us a global reach, but with a tighter team than others. So the takeaway here is that we grew sales significantly. We kept production productivity high. We protected our profitability and even with fewer reps in the field. Next slide. For the HR side, our business goals for these quarters were to improve employee morale, reduce turnover, increase worker satisfaction, improve supervisor satisfaction, and raise productivity. On the HR side, our main goal was to boost employee satisfaction from the first 3 quarters. We saw production worker satisfaction rise to 87% by quarter 6, which was a big improvement for us. Supervisor satisfaction improved too, though at 73.5%, it's still lower than our competitors, and that's something we'll want to keep working on. Our morale climbed from 65 to 71, but again, our rivals like Thunderbike and Biked hit into the 80s. Where we made strong progress was retention. Our turnover dropped from 26% in quarter 2 down to 15% in quarter 6. So that was a big step forward for us. Finally, our productivity improved from 72% to about 79% without overtime, which shows our investments in workers did pay off. So overall, our HR improvements were solid, but there's still a gap between us and the industry leaders. Looking at the next slide, sorry. Looking at the big picture, first, we deliberately prioritize sales efficiency over headcount, which helped us keep our costs down and margins high. On the HR side, we focused on boosting production worker satisfaction first, but that meant slower gains in supervisor satisfaction compared to our competitors. A couple of challenges that did hit us was our reputation plateaued at 69, while other companies pushed into the mid-70s, which limited some of our market growth. We also carried an ill will penalty of 261 units in quarter 6 from earlier stockouts in quarter 5. And with our plant running at 97% capacity, we had to lean on overtime, which did raise our costs. Even with these challenges, we did outperform on our key KPIs, and we finished in first place overall. But to stay ahead long term, we need to keep investing in people and our reputation.
So these were some goals that we met, some that we didn't. The value markets and affordability. So we keeping our rec bikes affordable. Our mountain were about mid-range. Our speed was more expensive. That was more because of the quality and the performance. And then we wanted our profits and cash flow. We delivered on that part because we had a positive cash flow and a strong shareholder value. And we were focusing on superior manufacturing. It's quarter 6, there was no stockouts, and we had efficiency production. We were aggressive, which we want to be. And then we were also focused on environmental and safety. So for that, we invested in clean rooms, chemical disposal systems, and protective gear for the workers. And then also we wanted to keep up with the top competitors, but we ended up being the top competitor in the so competitive edge. Also, we challenged them, and we stayed ahead of all of them. Customer trust, we were strong early on, but it declined when we didn't invest in the carbon fiber the last quarters. That's what hurt us overall, but we will eventually. And the sales force satisfaction, that was low because of the pay and benefit lagged behind the competitors.
So looking towards the future and our preparation with competing, we've built a strong financial base. We were consistently profitable, cash positive, and debt-free. On the sales side, we've proven we can run a lean, productive team, hitting 5.5 million in sales in quarter 6 with strong margins while expanding into 4 major global markets. From an HR perspective, we strengthened our workforce. These improvements set us up for sustainable growth without sacrificing employee stability. We've also made major investments in capacity and R&D, ensuring we can scale production and innovate faster than our competitors. Looking towards the future, our biggest opportunities are in improving our reputation, employee morale, and supervisor engagement. Once we address these gaps, we will not only compete, but we'll have the foundation to lead the market long term.
As for our overall group experience, the way that our team most benefited was through the development of soft and hard skills, such as avid communication and knowledge in terms of business strategy. We were able to gain experience on starting and running a corporate in an intangible way. We also mastered carrying out teamwork in a transparent fashion since everybody was really good at communicating. Then we were also able to work in a group with diverse personalities, which then became a benefit and probably made our corporation succeed. Lessons that can be taken away. We believe that perfection does not equal success. Also, strategic risk should be taken in order to advance in the market. And this is done so that your competition doesn't take this risk first and then outperform you in the end. Then also, projects succeed when members are honest, involved, and transparent in how we do things.
And that is it. Thank you.